Hey everyone, and welcome. Today, we're tackling a big one, stock valuation. We're going on a quest to figure out what a company is truly worth, looking way past the ticker symbol to crack the code. Let's get right into it.
This is the fundamental question, right? You see a stock price flashing on your screen, but that's just what someone paid for it a second ago. Is that its real, its intrinsic value? That's the mystery we're going to try to unravel today. So welcome to the Analyst's Toolkit. Think of this as us opening up a professional's toolbox and handing you the core instruments they use every single day to figure out what a company is actually worth. Okay, our quest for true value starts right here. We're going to build this thing from the ground up, starting with the most basic, foundational ideas of valuation. All right, the first tool out of the box, this one is an absolute classic for a reason. It's one of the oldest ways to value a company, and it looks at the cold, hard cash that it puts right back into your pocket, dividends. The logic here is actually beautifully simple. When you buy a stock that pays a dividend, what you're really buying is a stream of future cash payments. The dividend discount model, or DDM, just does the math to figure out what all those future paychecks are worth in today's money. Simple as that. Now, don't let this formula scare you. You don't need to memorize it. The point is to show how a simple idea can get way more sophisticated. This is the H model, and it's cool because it accounts for a company having a period of super fast growth that eventually, slows down to normal. It's just a more realistic take, but the core idea is exactly the same. So to make one of these models work, you need a few key ingredients. This is a pretty typical setup. You need to know the required return. That's what an investor demands for taking on the risk of owning the stock. Then you've got to estimate the dividend growth rate, and of course, know what the current dividend is. It really is all about forecasting the future. But you can't just plug in any numbers you want. These models have rules, and the most important one is this. For the math to work out in the long run, the company's growth rate has to be less than the investor's required return. And always remember, this is all about looking forward. The past is a guide, sure, but what really matters is the expected future growth. Okay, so this brings us to a huge problem. The dividend model is great for stable, mature companies. Think utility companies. But what about all those exciting high-growth tech companies that reinvest every single penny they make back into the business? Our first tool, it just can't value them. We need something more powerful. So, now it's time to bring out the power tool of valuation, free cash flow. This is way more versatile and, honestly, probably the most widely used method on Wall Street because it gets right to the heart of how much cash a business is truly generating. And this power tool comes in two main flavors. First, you've got free cash flow to the firm, or FCFF. That's the total cash the company generates before paying its debts. It's the cash available to everybody, stockholders and debt holders. Then you have free cash flow to equity, or FCFE. This is what's left over for us, the stockholders, after all the bills and all the debt have been paid. And you can really see the difference when you put the formulas side by side. Look, they both start with net income and adjust for things that aren't cash. But then, see how FCFF adds back the interest paid to debt holders? Meanwhile, FCFE deals with things like net borrowing. It's all about figuring out whose cash you're counting. Okay, this next part is super important, a really critical detail. To figure out what that future cash is worth today, you have to use the right discount rate. For the whole firm's cash flow, the FCFC, you use the weighted average cost of capital, or WACC. That's a blend of the costs of all its financing. But for the stockholders' cash flow, the FCFE, you just use the cost of equity. Getting this wrong is a classic mistake. And just like with the dividend model, this is all about telling a story about the company's future. Here are the kinds of detailed assumptions an analyst has to make, like projecting sales growth, guessing at future profit margins, and figuring out how much the company needs to reinvest to keep that growth going. Every single one of these assumptions can change the final valuation. Okay, deep breath. We've done the heavy lifting, we've built our detailed model, and we've calculated what we think the company's intrinsic value is. But we are not done, not even close. Now it's time for a reality check against a real world. And this is the key difference between what we've been doing and what we're about to do. Intrinsic valuation is building a value from the ground up based on the company's own numbers. Relative valuation is way simpler. It's basically just looking around and seeing what similar companies are selling for in the market right now. We do this with something called market multiples. You've definitely heard of the PE ratio, right?
the stock price divided by its earnings. Well, these ratios are like powerful shortcuts. They tell you how much the market is willing to pay for $1 of a company's earnings. And it's a crucial reality check, because no matter how great your model is, you still have to know what people are actually paying for similar stuff today. So here's a perfect example in action, using the PEG ratio. This one's cool because it compares the PE ratio to the company's earnings growth rate. By lining up a few competitors like this, an analyst can spot pretty quickly which stocks look cheap or expensive compared to their rivals. So here, you see companies A and C have really low PEG ratios. That could be a signal that they're undervalued compared to company B. But the quest for value doesn't stop there. I mean, the best analysts, they keep going. They add layers of nuance and use even more advanced tools to get a more complete picture. So one of those advanced tools is the residual income model. This one takes a totally different angle. It starts with a company's book value, what it's worth on paper, and then it adds on the value of its future economic profits. And what's that? It's any profit it earns above and beyond the return that its investors demand. This formula really gets to the heart of it. Just look at the part in the parentheses. ROE minus R. It's asking one simple, powerful question. Is this company earning a higher return on its equity than what investors require? If the answer is yes, it's creating value. If it's no, it's actually destroying it. And valuation isn't static, it's evolving. A huge thing right now is figuring out how to work in non-financial factors, what we call ESG, environmental, social, and governance. So, for example, the risk of a future environmental fine, that can be built right into the cash flow forecasts. A hit to the company's reputation? Well, an analyst might demand a higher rate of return to compensate for that risk, which in turn lowers the valuation. After all these models and all this math, we have to remember this crucial piece of wisdom from Professor Aswath Damodaran, who's basically the dean of valuation. He says valuation isn't a science, it's a craft. It's about building a coherent story, making a strong argument, not about finding one single magic number. And that leaves us with one final thought to chew on. In a world of intangible assets like data and brand recognition, in a world being constantly disrupted by AI, what is value even going to mean tomorrow? The tools will definitely evolve, but that quest for true value, that's going to continue. Thanks for joining this explainer.